Let's be honest, we all know the stock market can be a total roller coaster, right? One minute it's up, the next it's down. But what if your income didn't have to be tied to all that chaos? Well, today we're diving into a strategy that's all about creating a reliable stream of passive income, month after month. Let's get into it.
This quote right here, it just nails the whole idea. This isn't about gambling on the next big thing. Nope, it's about building a system, a machine, that delivers a predictable flow of cash right into your pocket no matter what the market is doing.
So why is this so important, especially right now? Because when the market gets shaky, stability is everything. We're going to see exactly how dividend investing can be your anchor in that financial storm.
What you're looking at here is a huge shift in mindset. See, most investors are playing the growth stock game. They're chasing that price appreciation, hoping and praying a stock's value goes to the moon, and, that could be a real gamble. The dividend approach is completely different. The focus is on predictable cash flow, actual money deposited into your account on a regular schedule.
And this brings us to one of the most powerful forces in the universe of finance, compounding. We call it the snowball effect. Just picture a tiny snowball at the top of a big hill. It starts small, right? But as it starts rolling, it picks up more and more snow, getting bigger and moving faster. That is exactly what can happen with your money.
So how do we get that snowball rolling? Well, first, you get paid every single month. That's a huge psychological win, and it makes it so much easier to stay in the game when things get a little rocky. But the real secret sauce? Reinvesting. You take those dividends and you plow them right back in to buy more shares. And guess what? Those new shares then start paying you more dividends. That, my friends, is the snowball gaining some serious momentum.
All right, enough with the theory, right? We've covered the why, so now let's get our hands dirty with the what. We're going to look at 3 specific investments that are designed to pay you every single month.
First up, we've got AG&C Investment Corp. In the world of monthly dividend payers, this one is an absolute heavy hitter, and you're about to see why.
Whoa, just take a second and look at that number. A dividend yield of roughly 14%. To put that into perspective for you, that is way, way higher than the historical average of the S&P 500. This is the kind of number that makes income investors, really sit up and lean in.
So what is AG&C exactly? It's a mortgage REIT. Now, don't let the fancy terms scare you. It just means instead of owning buildings, it invests in big bundles of home loans, mortgage-backed securities. Now, sure, its value can be a little sensitive to what interest rates are doing, but its track record speaks for itself as a consistent, high-yield monthly payer.
Okay, our second example comes from a name you've definitely heard of, JP Morgan. It's an ETF called JEPQ, and it has a totally different way of generating that monthly income. And boom, another powerhouse yield for you, typically hanging out in that sweet 10 to 11% range. It's another amazing income generator, but how it gets that income is what makes it so interesting.
JPQ is what's known as a covered call ETF. Okay, what in the world does that mean? Basically, the fund holds a bunch of those big NASDAQ tech stocks, and then it generates extra income by selling options on those stocks. It's a really clever strategy that lets you get exposure to all that tech sector growth while also collecting a fat monthly dividend. It's kind of the best of both worlds.
And that brings us to our third and final example for today, Ellington Financial, also known as EFC.
So EFC clocks in with a very solid yield of around 11.29%. And while that number is definitely impressive, the real story with EFC is its reputation for being stable and consistent.
So, like AG&C, EFEC is also a REIT, but its big thing is diversification. It spreads its investments across a much wider range of credit and mortgage assets. And that wider net is precisely what's earned it this reputation for being such a stable and reliable monthly payer.
Okay, so we've got our examples. But listen, a list of stocks is not a plan. So how do you invest in them in a smart way? Well, that is where the beautifully simple SIP plus DRIP strategy comes into play.
This 3-step plan is your blueprint. First, you use a systematic investing plan, or SIP, to put your investing on autopilot. This is how you take the emotion out of it. It helps you avoid that classic mistake of trying to time the market. And then, step 3, this is so important. You enable DRIP, which puts every single dividend you earn right back to work, fueling that compounding engine.
So what is SIP? The idea is just pure consistency. You invest a fixed amount of money every single month, could be 100, could be 500, whatever works for you, and you automate it.
This is also known as dollar cost averaging, and it means you naturally buy more shares when prices are low and fewer when they're high, without even thinking about it.
And if SIP is the plan, then DRIP is the accelerator pedal. A dividend reinvestment plan simply tells your brokerage, hey, every time I get a dividend payment, don't give me the cash, use it to automatically buy more shares. This is the engine that really drives that snowball effect we talked about, making your investment grow so much faster over time.
Now, it's really important to set the right expectations here. Compounding is not a get-rich-quick scheme. The growth, it starts slowly. It does. But if you stay consistent and you give it time as you keep reinvesting, that growth curve starts to get really steep really fast.
So let's put this all together. When you combine these high-yield monthly dividend payers with the SIP and DRIP strategy, you're not just investing anymore, you are building a compounding machine.
So what are the keys to making this work? It all boils down to these 4 things. Focus on the steady income, not the daily market chatter. Stay consistent by automating your monthly investments. Reinvest everything to fuel your growth. And, maybe the most important part, just have the patience to let the machine do its thing.
The strategy is straightforward, the tools are out there, and the potential to build a truly steady stream of passive income is very, very real. The only question left is the one you see right here.